Good afternoon, everyone. It's Chrissy from Solstice ATR. Hope everybody's doing great. You can find me at Solstice on Twitter, Instagram, Discord, and you can DM me on either Twitter or Instagram or Discord. At the same time, we use adaptive algorithm for side market, down market, as well as up market. Remember, this video is on weekly basis coming out for free. You can subscribe. If you like this video, hit the smash button. We're not a broker dealer. Past performance does not indicate our future results. Use at your own risk. Data may not be copied unless requested either by the website or giving us a call. In this week's video, I want to cover a couple of things that will help you in trading not to be biased to either side and understanding the risk involved by taking a Fibonacci or taking a channel and an angle and the distance you travel in it percentage-wise in relationship to the different instruments out there in the market or equities. Let's go first. Take a look at the slide that I'm showing you here. I'm going to expand it in full so you can see it a little bit more better. This is the advanced decline line of the New York Stock Exchange as well as the Nasdaq, showing what the advanced volume, that means the number of stocks that were positive in relationship to the ones that were declining, and the total volume for the day on the NYSE. This is the NASD. Similarly, the prior day where we were in relationship to the volume has increased a little bit more from the day before on the NASD and then NYSE on Friday on the close. We got a small reversal. We use this for illustration use only, and you can ask us how we can use the advanced decline line to tell you what the trend is in relationship if there's a reversal coming on a short period of time or long period of time. And this is the weekly average across the board on the NYSE advanced compared to the decline average across the board totaled for the 5 days that we had. Let's escape out of here. Go to the next slide. Here I have the S&P 500, Nasdaq, as well as the Dow. You can see I wrote, what can we learn from history? Remember, history is past performance, does not give us indication of a future results. The reason why I am using this because we use adaptive algorithm to tell us whether we trading on an uptrend, a downtrend, a reversal, or the market is being in consolidation. Whenever you have a small little oval or a box that's consolidation in range until you get a break up or a breakdown away from being bullish to bearish or side action in the market. You can see that I had the Goldilocks rule here, the baby bear, the mama bear, the consolidation in January, February before the rally. Then in January 3rd, we fell down. We created lower highs. We kept testing the 50 SMA. Couldn't clear that triple top here. We fell further down. We consolidated here for a week. Then the 4 weeks were side action. We rallied back, cleared the 18. We were expecting, to push above the 50 SMA, failed right there. And we fell back in range to touch the 200 SMA right here. And we have the 250. This is the mid-range of the August, September, October of 2020. You can see here at the same time the February 19 breakdown as well as the March 23rd reversal back up. In case the market's still trending to the downside and coming to the downside, we would look for retesting the mid-range of this area, which would be the 250 SMA. And if a little bit below, we test the prior February, June, July, the rally before the continuation back up. If we get a reversal here, that'll be great. If we reverse next week back up to the backside of this channel that we broke down from, pay attention to it. Last but not least, if you like this video, once again, hit the smash button and you can subscribe on weekly basis for this video directly from YouTube. It's for free. And if you need to get in contact with us, there's our website, there's our phone number. Let's go to the next slide here. I'm showing you the same thing that I showed earlier, but what we want to use is the distance we travel from high to low to show you the total return. We can get this channel here from the low here to this high. We had created 116% return all the way from the March 23rd till the high. And if I look from the January 3rd all the way down to here, we have fallen 24.5% of that move. If I'm going to fall further down to the 30% range or the 250 SMA, that would be around the 27-25%, and that range for those three instruments would be about there. This is just a slightly above on the February high of 2020 before the COVID-19 hit in February 19, and we fell sharply to March 23rd low. And if we're going to go all the way down to the backside of this channel and the consolidation of those moves, that would be a 30% decline in the overall market from the January 3rd of 2022 till down here. How do we use this in order to help us? So what we can do is get a Fibonacci. We get a Fib. I'm going to grab the low from here, which you can see in March. I'm going to grab it all the way to the high. We can see the 50% is right here. The high is up here. The 25% is here. 50 is here. 75% and 100% is down there. What I know that the 50% would be this consolidation right here and almost the mid-range before the falling down. If the 200 SMA holds us, that's great. If not, we come back to 2/3 of this linear regression downtrend. That would be great. But if I want to take the distance from this high to the low that we had from the 50 SMA all the way down to the bottom where we fell, we got a bounce off the 200 SMA, we've fallen 15.5%. Why am I showing this to you? I'm going to use the dollar in relationship to that move down to calculate the differences between the instruments in order to give you a better understanding of the overall market. Remember, the Dow represent 30 companies. The Nasdaq 100, the NQ, represent the Nasdaq or the QQQ, the top 100 companies in the tech sector. At the same time, the S&P 500 represents the 500 companies in the SPY, which is the Fortune 500 companies in the market, such as Apple, Amazon, Costco, Walmart, Boeing, Target, Microsoft, Oracle. I'm just going down the line, Home Depot, Lowe's. So you get a variety of understanding how it works. So if I take the Dow Jones Industrial Average out of there, I want to do this here all together. We're going to push enter. It's going to change the criteria from the high to the low. If I take this high to this low that we had, we've fallen 17.59%. Let's call it 17.5% down in the market. And the reason behind it, if we're going to fall another 20%, that would be about, if we fall here 20%, that would be at the bottom of that consolidation on those two instruments. And that would give us the bottom range of this consolidation right here that we had in August, September, October before the November rally high. So if I'm going to fall into this range to the low of it, that would be about 23%. Let's take a look at the dollar, how it works in relationship to this move. We're going to put a dollar sign, DXY. This is our American dollar against all the currencies around the globe. Our dollar has really pushed very high. Your dollar, whenever you travel overseas, you tend to spend less because our currency is very strong in relationship to the European, to Canada, to South America, Africa, Australia currency, as well as the Chinese currency or the Russian currency. We know Russia is almost obsolete. We still are at war between Russia and Ukraine. The European zone is a little bit under electricity of the economy slowdown, the cost of gas, natural resources and stuff like that. At the same consumer products we have here in the U.S., as well inflation. The Federal Reserve Board wants to keep interest rates low. Let's take a look how to use this percent in order to calculate the return in the market whenever we have a rally up or rally down. Remember, we almost tested the 18 simple moving average. You can see the August 8 was the low for the market. If we take that low all the way up to the high right here, we had an 8.25% increase in the dollar in the last 2 months. If I take that 8.2% and I'll multiply it by 2.25, 2. Okay, we're going to call it 2. We're not going to use the 2.1 times 2.25 that will give us about 18%, 18.5% of the market move. And if I don't use the wicks and I use the body of the candle all the way to the body of the candle, that's 6.99. Let's call it 7%. Okay, 7 times 2.5%, that will give us 17.5. If I use the bodies on the dollar and I calculate 2.5%, 2.5 times that percent that we moved up, the market has to go down that percentage to the downside. And this is why the Nasdaq and the S&P showed you that 7.56% rate of return down in the market. This is how we calculate the risk in relationship to our dollar. Usually the dollar moves with the market before. Now the dollar moves opposite to our market. When the dollar goes up, our S&P, Nasdaq, the Russell, the Dow moves in opposite directions. So you have to understand, when the dollar comes down, take that percentage, whatever on the daily basis, weekly basis it moved, and you calculate the move in the S&P and the Nasdaq, the Russell, and the Dow, at least to get a better idea between 2 times to 2.5 times that move in the direction of the market heading to. So let's take a look at now the micro ES. We can see that the micro ES, we are almost on the January 4th of 2021 low, and this was the December high. That was the January 3rd. We've fallen back down. The distance we traveled from high to this low is 15.4. Can we continue to get a 20% decline in the market? Yes, that would be about the 3,458. Can we get a reversal on an H pattern? If I consider this an H, okay, and we get a double bottom and this consolidation hold us, that would be great. If not, we're going to come back to this spot where we consolidated in the prior year because the economy has slowed down, and this is why we're using the micro ES. Or you can look at the ETF fund, which is the SPY, the mirror image for the S&P 500. Okay, so let's take a look at the micro NQ. You can use the QQQ. Here we can see that the Fibonacci's are very similar. That was the March low of 2021. We've fallen further down. We almost retested the 23.6% fib to the downside. In this box, we are coming to that area. We are halfway through that box. You can see we tested a little bit and we came back to close 2/3 of that box down. If the Nasdaq wants to fall further down, can it retest the 38% and lose the 23, 27%? Yes. Is it possible? Yes. Is it possible to reverse back up? Let's say we end up reversing in the next 2 days and we come to the 61 between this linear regression channel and this linear regression. This is your 61.8 fib. If I put my candle here all the way back to the chart, that would be an 18.5% increase in the up move. If I'm going to fall down extra from this area all the way to up here, that would be a 22% decline from the high that we had in August 15 of 2022. From that high to that low, we have lost actually 22% if we're going to come down here. This is why you use that percentage to calculate the data. Let's take a look at now, which remember, this is the QQQ. If I want to look at the micro 2K, which is the small cap IWM, I'm going to use a Fibonacci here to show you how to calculate it so you can see how we can look at a fib regularly. I'm going to use the 0, 25, 50, 75, 100 and the extensions to the upside. If I want to look, this is December, this is the January low to the December, this is the November high of 2021. You can see my Fibonacci, my zero line where my 150 is. If my 150 is lost, I can edit the property. I can show you how to add those lines, add a curb. If I'm going to add a curb down here, that's a 200% minus 200 minus 2.0. The 2.0 are usually in white color and they are solid. And if I'm going to add another curb and I'm going to add a minus if I'm going to add 2 to it would be this line, and I'm going to make it Y at the same time to show you how I add them. That would be 1, and if I'm going to add instead of a 1.5, I'm going to add a 1.75. That would be the color in purple. You can see it, and it's a little dotted line. And if I'm going to add the minus 175 to the upside, minus 1.75, that would be small purple at the same time that we had, and I would color it in purple. Come on, and click the purple line here, and we have the lines for the charts on the Fibonacci extensions from the high to low and low to high, as you can see on the charts. That means if we're going to fall 100% of this move from the January 4th to the high, we can see that the 175% is here, which is around the 180 or the 78.2 Fibonacci. That would be around this here. And this linear regression downtrend channel, you can see my upper and lower, they are parallel, and this is the channel we broke up. We tested the 50 simple moving average, and we fell down here, and this is why I use this Fibonacci to help you out. Look at the differences between the high and low, and if I go from low to high, you can see from the January high to low, this is where my 50% would be for the charts for the 2-year on the small cap Russell remove drawing. We'll keep this on the chart so that way you can see it next week. We're going to take a look at the micro Dow Jones Industrial Average, is the DJX. You can see that once again where the fibs are. This was the consolidation in February. This was the December. This was the January 4th. You can see that the February low was here to this high. We can see where the 125 and the 150 is. If I'm going to come to the 127, it would be here. If I'm going to come to the 123.6, it would be down here. This is just looking at it, averaging it out, and you can see where the fibs are. If I'm going to look at the 2-year range for the Fibonacci from high to low for the 2-year that we had, we know our 50% is usually around this area, which would be around the 127.8% fib. I can take this Fibonacci out, and you can see the 2-year range where they are in relationship to the 1-year chart Fibonacci. I hope this is helpful. Let's go look at one more other instrument. Let's take a look at GC, the micro GC. The micro GC is actually GLD in gold. You can see the micro GC, we were in a linear regression downtrend. Eventually, we double topped. We fell down in a linear regression sharper downtrend. We are retesting the breakout of this channel. If the gold does not hold here, I'm expecting this candle and this halfway consolidation of this area would be this area here to hold in the Fibonacci's on gold. If I take the range on gold from low to high here, from the prior couple of years, this is my high and low. You can see where my 50% is, and that usually lines up very well with the consolidation of the box before the rally high in GC, which is gold. Let's take a look at the micro CL, which is crude oil. You can use USO. We can see that the crude has lost its major retracement channel, fell through this channel, double topped here, couldn't hold, retested the 93 area, couldn't hold it. We further fell down back to the 75. This was the 4 soldiers that took you higher. You are in this consolidation of this area. I would look for this area here, this area to hold in case we come back to the backside of the breakout of this channel. That would give us a better reference remove drawing. I can grab this channel from here. We use the Fibonacci. We can grab this channel here to this candle, and we can see that the linear regression downtrend is starting to wedge. If I end up coming back to this area and getting a nice bounce, I would take oil back to the upside, back to about the 85, 89 area. And if it comes back between the 76 and the 72, that would be a good area for consolidation for a bounce back up, continuing in crude oil back up in price of it. After the Ukraine-Russia war, this was the push up, came back in, price of Crude was up there. You can see my oval here was on the retest. When we retested this consolidation, we rallied up and I called this short and I called this short here. So far we are still in a downtrend until we reach the backside of this channel. That would give you a better reference on the chart in crude oil to purchase. You can look at USO. Let's take a look at BTC. We're going to use the micro BT on the chart. This doesn't have any channels. We can see in the micro BT we have a gap here. We do have a gap up here. We've fallen through. This gap was filled on the way up. That double top, when they introduced it, it wasn't there. The micro BT, they only had slash BTC. The reason why you look like it's coming down to this bottom of this channel, there's consolidation here. I'm going to show you how it looks like on the big contract BTC. So, slash BTC, my fault. Okay, we can see that BTC is coming to an area where there's a lot of consolidation here on the daily and the weekly chart. There's a gap that it filled. It still has this little more gap to go at the bottom here. In case we do find support here and we reverse back, that would be great. If in case it does not, it doesn't have any support here until it reaches that 13,000 to the right side. What I'm going to do is zoom in. Take this area here by itself. You can see these two gaps. I wrote them here. We have not been able to clear the 25 on the retest of that up channel. We fell back down. If BTC finds support, that would be great. You can see where my ovals are. In case they reverse and clear this area, I would look back to the upside of the filling the first gap. If it falls further down, you'll look for the backside of the 13.5. 12,900 for a repurchase of BTC. That would give you an opportunity to grab it back at a lower discount for a nice little bounce back up in BTC. Let's go to the equity side. I'm going to show Apple. We can see Apple on this the last couple of weeks. It retested this gap, filled it, fallen back down. This week tried Apple to come back up, fallen back in. It's retesting the fair market value of the high of the monthly measured move. It's sitting right on it. If it falls right through, you look for the 50% for another buy zone in Apple going back up. Let's do Google. I'll do a couple more. Google has fallen down quite a bit from where it was at the high after the split. You can see that linear regression did not hold it. It's falling back down. This is a consolidation area. If Google reaches the 200 SMA, and find support in this area, that would be a great area to purchase Google. Let's take a look at General Motor. I'm just going through a couple of different things so that way you can guys get a better feel of what the market can do. Oops, come on. General Motor. We can see that General Motor on Friday sold off very heavily. We know they're trying to make a change in the industry. Them, Ford, General Motor, Toyota. Everybody's going. We lost 100% the annual low for the year. Is it going to retest the 127, 123 to find support, or does it continue to the backside of this consolidation before the move back up in GM? Let's take a look at BA. BA has a nice area that we can look for support. There's a gap here on the daily chart. I am looking for that area if Boeing can find support in that area. We can look at the AXP. Similar situation. Caterpillar, you can see the way the gap is in AXP, American Express, on the 200 SMA in the backside of this channel. If I take a look at CAT, you look for opportunities. It has filled the gap. Doesn't mean it's going to find support here on this backside of this channel, or does it further fall back down to this consolidation before the breakout rally, because you had the retest once, twice, three times. Couldn't make it here, fell down, reconsolidated here, and broke up on the breakout. Does it retest this major area of consolidation before the U-turn in Caterpillar? Let's go back to the S&P 500. SPY will use the ETF fund once again. I'm going to do it on a shorter time frame. Once again, how do you measure the distance you're traveling? This is last week's range from the monthly high in August 15 all the way down to here. We have fallen 15.85%. If I'm going to fall further down and I'm going to retest the 200, that would be 17%. And if I'm going to test the 250 SMA, that's going to be about 21% right there in the S&P 500. If I find that the market going to find support between the 200 and the 250, and I end up reversing in this area on the 200, I would expect to retest half of the body. That would be 5.5% of the move. And if it tests the upper side of that breakout or the close of this candle, that would be about 6.75, 6.8%, and the upper body of the other candle, that will change the trend, and that will give us an 8.5% return back to the upside in the S&P 500. And if I'm going to fall further down another from the close here, another 5%, that would be about, let's take a look at it, that would be about $350, $49, $50 range. That would be a mental number in the S&P 500 to look for in SPY, or you look for the 348 area for getting a nice little small bounce in SPY. Let's go to the ES. And here you can see my Fibonacci's. What I want to do is go to a shorter time frame. Looking at it on a time frame, we're going to go intraday. We're going to use a 10-day range, and we're going to go to a 4-hour chart. You can see where the ranges are. And if I zoom down from high to low, you can see that 5-day consolidation right here after we did 2 days consolidation the prior week. This was the announcement from the Federal Reserve Board on Wednesday, Powell increasing that 75 basis points. The distance we traveled from high to low. This was the Fibonacci that we retested. We fell through it. That was the short coming down the distance you traveled from here to here. You can take the same distance. We can create a box to show you how to do that. You can take the high from here to this low here. And if I duplicate this box, activate or duplicate the drawing, and I grab it down to the downside, you can see where the breakdown was. You can see that the retest of it is exactly, of the overnight action, and the price of the Fibonacci's are almost identical. And if I do a fib on it for the 2 days range, you can see where my 50% is in relationship to the 38.2, 25, and 78%. This was why I am using this Fibonacci to show you how to use it correctly on the moves remove drawing. Hope this was helpful. You have questions, please check us out at the website at Solstice ATR. Take care, over and